Well, hello, and welcome to Iowa Ideas in Depth Week. This is our 9th year of Iowa Ideas, an event that explores topics that are important to Iowans. We're excited and continuing the great week of discussion that we're having on extreme weather and the impacts on Iowa. Before we get going, the Gazette would like to give a special thank you to our presenting sponsor, ITC Midwest, who has been with us for all 9 years of Iowa Ideas. And this support is really crucial to us. It helps make the discussions free for all, and helps us bring together some really interesting conversations throughout the year as well. For those that are joining us live, you'll be able to submit questions to the panel today, and you can enter them in the Q&A box on the Zoom chat, and I will be working to bring them into the conversation as we go. I am Zack Kucharski. I'm the executive editor at the Gazette, and today I'm joined by a couple of great panelists, and just behind the scenes, quick discussions were able to be had. So I think it'll be a lively conversation today. So I am joined by Martin Grace, who is the Clement T. and Sylvia Hansen Chair of Finance, and is the director of the Vaughn Institute of Risk Management at the University of Iowa, and Linda Langston, a former Lynn County supervisor and NACO president, who also leads Langston Strategies Group. So I will start with each of you, maybe if you want to expand on the titles and areas of experience from there, and then I will jump into questions. Martin, do you want to give a little bit more on your background?
Sure. I'm an economist, and I've been studying insurance markets in a number of different ways, but I've been fascinated since Hurricane Andrew by the effect of sort of natural disasters, large natural disasters, and unexpectedly big natural disasters on the ability of insurance markets to recover and to provide coverage. That creates some problems because the government, citizens and voters all care about this too, and so we have this nice interaction between private markets and insurance regulation, and the federal government's thinking about various things about this. And I just think this is an interesting area where we have states, federal governments, private markets, customers, voters, everybody interested in these topics. So that's what's been my focus for the last, on and off for 30 years.
Thank you. Linda.
So I work primarily in the area of both resilience and disaster resilience. As Zack noted, used to be on the Board of Supervisors, and worked at the National Association of Counties in DC for a few years, returned here just in time for the pandemic. So ended up answering a lot of questions because I also serve on the National Academy of Sciences on 2 different committees. One is the Division of Earth and Life Sciences, and the other is, awful name, but Societal Expert Advisory Network. But we were busy answering questions about co-occurring disasters. What does this mean when you have 2 things? So for us here in Cedar Rapids, when we had the derecho and we also had COVID, it made it extremely hard to respond in the same way. So I've found that over the years, I've been dealing with disasters ever since my own house first flooded on the day of my first primary election. And I've frequently said it should have been my memo from God that I would be dealing with disasters for much of the rest of my time. And so, as Zack noted, I've been through 2008, 16, 2020 was here for that. I've been around in some other communities and worked with communities as they do their recovery. So also served on FEMA's National Advisory Council, and continue to work with a lot of the people I've crossed paths with, because it is a challenging issue in communities to really effectively adopt the policies that we know can have an impact in preventing future disasters and all the impacts that come with them.
All right. Well, I will jump in, and Martin, I'm kind of curious, you teed it up pretty well, but kind of that intersection of extreme weather and the impact on insurance. And, and I think that folks are seeing premium increases in Iowa. We've had a few insurers leave the market, but is that the only thing that's going on in the space? Is this a direct cause and effect, or are there other things that are also kind of hitting at the same time? What does the landscape look like from your vantage point?
So I don't know if you had a dial from 1 to 100. I would say that climate issues are in the 0 to 5 range, but recently, the real problem has been the inflation that we've experienced since like 2019. So housing prices are up in many places throughout the state and the country, but between 40 and 60%. In Iowa, they're in the 40% range. If you think about that, is most of you, who have homes, you bought it for a certain price, and you bought your insurance for a certain price, and the sort of the ratio of the insurance to the home value was in your head. But over the last couple of years, home prices have gone up, and so of course insurance has to go up to cover the extra amount. In addition, there's been inflation in wages. There's been inflation in like the things that you use to build homes. Now we even have a little bit of a potential tariff inflation. We haven't had it yet, but there's an expectation that if we, import wood from Canada, that there will be an additional, charge for that. So a lot of what we're seeing, I'd say from 2019 to the present, is mostly due to this inflationary shock that we've had. And it's, in part, I don't want to, place any blame, but it's our fiscal policies that have changed. We're providing extraordinary amounts of government spending for various things. And this happened during the pandemic, of course, and more recently for vehicles and equipment that are alternatively powered. So we just have a lot of money out there, and that's caused a bunch of this inflation. Now, if you go to the natural disaster part, I say it's 0 to 5%, and I think it depends upon where you are. So in Florida, for example, it's probably 10%. In California, because of wildfire risk, it's probably 7%. I'm making these numbers up in a relative way just to sort of give you a feel. But in Iowa, it's probably 3%. And we have had floods and derechos. The floods are not covered by traditional insurance, so they're not really in there. And the derechos are extraordinary wind events that don't happen very often. And because they don't happen very often, they don't get incorporated really into insurance pricing except for a little bit. So I would say that, compared to Florida or California, Iowa has had significant price changes in the insurance, especially homeowners insurance. But it's mostly been due to the underlying rate of inflation, which the whole country has experienced. And if you go to every state, there maybe not today, but there's a conversation like this going on in every state about the price of insurance. I just saw one yesterday in the newspaper about the state of Washington. And the state of Washington doesn't have hurricanes. It might have an earthquake, it might have a volcano, but it doesn't have the same kind of things that we have here. So every part of the country is affected a little bit. And then there's one last part, in that if we sort of think that the United States is the biggest insurance market in the world, and we have the most property covered and the most at risk. If you think of the state of Florida, for example, every inch of the coast, it seems like, is covered in, a glitzy high-rise building of some kind. It's not true, but that's what we think. And there's a tremendous amount of insurance capital going to protect those homes and those buildings and those commercial enterprises. And insurers use the international reinsurance market to do that. And if we have a big shift in demand for reinsurance, it raises the price of reinsurance for everybody, not just in Florida, but around the world. So if you think of supply and demand, we have a big demand to cover hurricane risk in Florida and in the Gulf Coast and maybe Hawaii. And that has an effect on all insurance prices all around the world. So it's not an Iowa problem per se. We don't have a big problem, but even if we say, are there prices and things outside the state that affect Iowa prices? Yeah, a little bit about the worldwide risk. And if you think of Europe with their winter storms, and Asia with their I guess they're called they're not hurricanes, but they're
Typhoons?
Typhoons, yes, thank you. I don't know why I forgot that one. But typhoons, but they don't have as much at risk as we do, in the United States. So it doesn't have a big effect. The United States drives the reinsurance markets.
I wanted to
One
ask,
thing
though,
I would just interject here. I would encourage you, Martin, to take a look at some things within the insurance market. I worked with Chris Flavelle at the New York Times when he was doing a big piece on the insurance markets. My husband and I happened to be profiled because we lost our insurance because a company pulled out of Iowa. They said it was no longer an insurance market they could afford to be in. So then when we tried to find insurance, we got turned down by everybody. And we actually had to go to every condo in our condo complex to prove to them that we had excessive work done in our roofing. So it was really high caliber, very wind resistant. We had to prove to them our water heaters, our air conditioners, all of our HVAC systems, and our paint was the highest caliber before we could get anyone to consider insuring us. And when we did, we paid 3 times as much for 1/3 the insurance with extremely high deductibles. And I discovered that there were a lot of people in Iowa facing that same problem. So I think there are changes in the insurance market that probably do have something to do with inflation. But I also think that it's more about the insurance business itself and their ability. If you look at some of the ongoing discussions in the New York Times about how insurance tries to make money, it's not been an easy time in the US over the last couple of years.
Well, I always say that when you have an insurance change, like when a company leaves the market, the next company comes along and is going to be skeptical because the company left the market. And so they have to redo everything again. And
but this was we went to 20 different insurance companies, and so they know, and these were places that know the market. And my experience was probably I talked to maybe 50 plus people that were in the same boat. And it was not always because insurance companies were leaving the market, but some insurance companies just terminated people for no apparent reason. So I think I don't profess to understand it all. I just know that it has an impact on a lot of people.
Oh, no, I agree.
And some people choosing not to insure, which is crazy too, but it's a challenge.
Well, we'll get to that, but Martin, does that go to kind of the risk modeling and some of the how when you're thinking of insurance companies, how do they decide? Has it been geographically based, or are we starting to see some of that change to widen out risk pools?
That it's very geographically based, and I suspect that this every time there's a novel risk in an area, whether it's or a hurricane in a place that hasn't experienced one, it's an earthquake where they haven't, a wildfire where they haven't had one. I believe the insurance companies overreact and either decline to continue coverage, or they withdraw from the market to figure out what they're doing. And it's because it's a novel thing for them, and they do have models, but they're based upon past data. So I suspect that, and this happened in Florida a couple of times, where they didn't have a hurricane for a couple of years, prices went down, hurricane came again, surprised everybody, and companies withdrew from the market. we would like to have more robust, modeling, but this is what they have. I think this is a short-term problem, but it's annoying to the people who have to suffer through the short-term problem. But I would say if you have 2 years of relatively calmness, then the market is a little bit more resilient to those shocks. But as I said, I keep phrasing these as novel shocks. A fire where there hasn't been a fire before, a freeze like in Texas a couple of years ago. That was a novel shock to Texans, and it had a relatively small impact on insurance. When during the 1990s, hail became a big risk in Texas and Oklahoma, and they were talking about whether even home roofs could be insurable anymore. But it just took some time for them to sort of digest the risk and figure out how to manage it. You would think they would be a little bit more forward-looking in this regard, but I know some of them are. I know some of them think about this, and they use more advanced models because they actually want to be, in the case that Linda was talking about, they want to be the person that steps in the door and saves the day. It's just, it's not exactly possible yet. But I think that's kind of like what their goal will be. I've heard executives talk like saying, we want to be able to be there when other companies move out, but they have to understand the risk to do that. So going back to your geographic question, I think property risks are going to be very geographically oriented, and that's because that every state's a little bit different, and if you think about sort of just the weather patterns we have here, and that's the biggest risk to a home is weather. Actually, fire is the biggest risk to a home. But that's generally caused by something that happens in the house, like an electrical thing or a kitchen fire, not a wildfire. But a fire is the biggest risk, and then weather is the next biggest risk. And and historically, fire has been a much bigger portion of the premium than weather, and that's changing. But the weather is different in every state, and so we have to understand what component that the weather is, and that can only be done on a relatively local basis.
Linda, I wanted to ask a question. Kind of, obviously, when you're an elected official, you're in the immediate response. But are you seeing an appetite change in terms of addressing these things proactively on the front end? Or I would imagine that the time isn't in the heat of the moment when people just want to get back in their homes. Are you seeing as extreme weather changes, is that changing the readiness and the desire to kind of address some of these things head on?
Well, I'll share with you a couple of examples. And yes, I think that it is largely because so many counties across the nation are experiencing disasters in a way that they previous to probably about 2010 to 2015, the extremity and the breadth of disasters was not as prevalent. So now you're seeing counties, small, medium, and large, who are being impacted by disasters. So people are thinking about this differently. But I would note that it's about policymakers, if in fact they have the tools at the local level to make the difficult decisions about planning and zoning that they need to. So I'll give you a more recent example, and this is in Kerrville in Texas, and that awful flood that happened down there. If you look carefully, Texas really doesn't allow local governments to do really anything in the planning and zoning arena. That's primarily held by the state in a very limited way. In Harris County, you can actually find that something about your lowest level of your building, they determine the freeboard, it's called freeboard height that you can build with. But in terms of like community, who can build where and do what kinds of things, that's something that happens at the state. And so I think the state legislature in Texas had a surprise when they did their hearings they discovered that, in fact, they had allowed the cabins that were swept away. They sought an exemption for those cabins to be built in the floodway. And the floodway is the absolute worst place in the world you would want to build. It's not even in a floodplain. It's why it's called a floodway. So I think some of these disasters, just in their scope, are causing people to think differently about what they need to do. Maui was sadly another example. I'm part of a group that we did the resilience plan for Maui, and in a change of administration, that all that planning was sort of set on a shelf. 6 months later, the fires happened in Lahaina, and everything that was in that report that they were asked to address, in fact, happened. And you saw what a disaster that turned out to be. So I think you're seeing these things happen, and local leaders are beginning to realize they need to take different kinds of actions. And I think you can see a lot of these here in Cedar Rapids. I mean, albeit the floods happened in 2008, but the enormous amount of work that has gone into both some of the planning and where people build, frankly, where we're not going to build, or where we're going to build in ways that buildings are raised so water can go through. You can see it in Louisiana. There's a lot of building happening on the northern edge of Lake Pontchartrain. And there are a lot of historic buildings there. So by leveraging a lot of federal money, a lot of those buildings, that like living parts of the building or the business part of the building, are now up on the second floor. The lower level is built in such a way that, okay, if Lake Pontchartrain blows in, it's okay, because you'll go in, you'll hose things off, and it'll be ready to go. But this was done in cooperation with the planning and zoning department there. So you can look around the country and you can see that more communities are trying to leverage resources to address the things they know might happen. And it doesn't come without political risk, because sometimes local people aren't really happy about what you do. And so then it can be a challenge.
Well, I also I'm interested from both of your perspectives. Insurance is something that, if you're talking about the National Flood Insurance Program, that's a federal program. But if you're talking about, homeowners insurance, which could come into play in a lot of these disasters, that's something that's, regulated at the state level. And I say, it's also still a for-profit business. They're not regulated to stay in a state and operate there at a loss. And so how do you balance, the right way to look at this? Because you could argue that, okay, you get a bigger pool to work with, if you had a federal look at, or a national monitoring of some of this insurance, but then at the same time, is that too big? And, you're trying to have too many sets of rules. How do you balance that?
Well, let me, I'll let Linda talk too, but I just want to make sure you understand what a risk pool is. It's not everybody in the country being a risk pool is a great thing. A risk pool is like risks are put into a pool. So if you have, and it might be that you could find similar risks in Iowa and in Oklahoma and in Kansas. It might be that you can do that, but you couldn't put a risk pool in Florida together with a risk pool in Iowa. They're completely different risks. They're not like enough. And so if we did that, Iowans would be paying tons more insurance. The cost of insurance would go up. So we want the risk pool to reflect the best risk characteristics of the property that's being insured. So that's one. A national risk pool is when everybody chips in kind of equally, and that's social insurance. That's not private insurance. So that one alternative is to have the federal government run, or some public entity, let's call it, not the federal government, but something like Fannie Mae or Freddie Mac, a company set up by the federal government to run that insurance. That's something that no one's talking about, but that would be kind of how that would work. But everybody would basically pay the same. The next best example is the flood insurance program, where the federal government says we're going to cover flood risk up to $250,000, and everybody pays something that looks like a risk-based price, but it's not. So they try to pretend there's pools. They try to say this is a high-risk area, this is a low-risk area, but the price that you're paying is a lot less than your real risk, and the taxpayers pick up that. And that may be something that we want to do for some kinds of disasters too. But that's a political choice, and that's sort of what happened to the federal flood market. But there is no silver bullet today to solve all this. If we think of the big problem, and it's that private markets do some things to sort of tell people that's a risky area, you shouldn't build there. States and local governments say, well, that's a flood, what you call a floodway. Nobody should be building on the floodway, for any reason, because that's just death waiting to happen. So some more coordination between this and sort of, I don't want to overzone stuff just for whatever reasons, but there's certain environmental reasons to zone, because it creates an externality that other people it causes problems for other people. So that's the role of the government, is to minimize those costs and to try and make it so that if you're in a high risk place, you pay a high risk premium, and that gives you a choice: do I want to live there or not? And right now we it's after the fact. So my insurance prices are so high, somebody has to do something about them, and that's true, and it hurts. It's a short-term problem, but it hurts in the minute or the year that you have to go through this. But over time, those things get resolved. Homes, just in general, take a generation to remodel, to move, to whatever. And the only way we can speed that up is maybe some state and federal resources, because the private insurance market won't supply capital for that, because they won't receive any benefit from it. So it's that's kind of like in a nutshell. I don't want to go on. I want Linda to have a chance to talk to.
Yeah, I think that what I would speak to in particular is flood insurance, and flood insurance was created in a time that back in the 60s, when arguably there wasn't quite as much disaster going on. And so making it, risk appropriate, like we left that behind long ago. We discovered, I was working on resisting some aspects of the changes that were made to flood insurance when Craig Fugate was the head of FEMA, and I also happened to be on the advisory council. We had our moments, but the challenge was that many communities that were built, because this is also a history lesson, if you live in places like Pennsylvania, Ohio, certain parts of North Carolina, Maryland, these were places that were built over 200 years ago. And they didn't seem to be that it was a bad place to build. But you can also look in Cedar Rapids and see that people literally built right on the banks of the Cedar River. And it wasn't until 1929 that we said, oh, we're not going to do this anymore, because it seems like every time the floods go through, we have to rebuild. And some of these places didn't make sense. So trying to align these pieces is important. Also within the insurance industry, there is not clear understanding of who can buy flood insurance and why. I've had 2 insurance agents here in this community tell me that I could not buy flood insurance because I did not live in a floodplain. You can buy flood insurance if you live on top of a hill, if you want to. It doesn't make any difference, but it's hard when the insurance people don't understand their own market. So then I proceeded to help educate them and say, no, here's the information from the federal government. We also discovered when we were doing some of the lobbying work with FEMA that there were about 40% of homes who had mortgages, this was primarily in the South, who by law, in order to get a mortgage, if you live in a floodplain, you have to get flood insurance. And we discovered that there were about 40% of the mortgages that were not enforcing that federal law. So that's, we have a convergence of many things that require the banking industry, the insurance industry, local, state, and federal governments to really come together and address some of these problems, some that have been built and that are left over from a couple of hundred years ago.
Well, and a lot of the things that we've talked about today aren't quick fixes, though. I mean, Linda, I don't know that you would have changed, the roofing or some of the materials in your unit. I mean, that's just not something that you would do willy-nilly. So to see, a community-wide change in that, the amount of time that takes is significant.
Yeah, I think the part of it is we need to learn to be a little more conversational about this, because there was a sea change in Florida that happened after Hurricane Andrew, and the state government put in place requirements about how people rebuilt, and they essentially had to build pretty wind-resistant structures. They discovered that paid off enormously because hurricanes weren't, Roy Wright was at the time the head of the flood insurance division. And he said, look, the only thing that's blowing away now are patio furnitures and grills, but the house itself was staying intact if it was built after Andrew or rebuilt after Andrew. One place that was exempted was in the Panama area, the panhandle of Florida, because it's a very economically challenged place. And so they were exempted from that law. And then when Hurricane Michael came along, of course, the entire community blew away except for one Sterling house that had built well above code. So we have to have conversations more that address these issues, Zach, where we're talking in our communities, like you're talking in the forum and in other places. There are reasons you want to put zoning codes in place. And we need to have those conversations with developers too, because developers see a river or any waterfront property is really attractive because it's going to be high value. So why wouldn't you want to build there? Well, if you look at the history of floods, you might say, well, how about if I stay about 300 yards away from the river? So all these conversations help, but I'll give you one other example, because sometimes you can get it to be market driven. And this happened in Tulsa, Oklahoma. So Tulsa is kind of in Tornado Alley. And they had a builder who chose to put a safe room on one of their model homes. They had 5 model homes. They put a safe room on one. So people went through and that was like, we'll say on model 1. Well, people might want model 3 or 4 or 5, but what they asked for was, could you put that safe room on this model? And so the market itself began to drive safe rooms being built as a part of homes. And that, I think, is what we ultimately want, is you want folks to understand you can make the choice to build a roof that's going to withstand hail, might be build a home that's going to withstand wind damage, whatever that is. And we need to talk about risk in different ways. Flood insurance is a good example. We talk about 100 and 500-year flood events. I testified at Congress and I said, don't I look good for having lived through to the age of 3,500 based on my flood experience? You know, and I got a laugh, Martin. That was really pretty good. The point being, if we use different terminology, if we talk about what the risk of your home of flooding is in terms of your mortgage, that if you live in a 500-year floodplain, you've got a 10% risk of your home flooding over the course of its 30-year mortgage. And it's higher if you're in that 100-year floodplain. So you have to make it in a way, because people assume, okay, if this was a 100-year flood, Zach, I know people around here say, well, these floods will never happen again because these were, it's like, actually, it's like being in Las Vegas. Your odds start over on day one. So we have to do a better job of having conversations that people can relate to, and they know what their real risk is in terms they can understand.
So I think the interesting things about that is that there's now a market for what's called I'm going to use a small f for a fortified home. There's actually a brand of fortified home with a capital F. And they had a natural experiment after, I forget which hurricane hit that panhandle in Alabama. Houses were destroyed and some were built according to this fortified home standard, which is a product of the Institute. I'm looking at here, the Institute for Home and Building Safety or something like that. It's just a think tank funded by the insurance industry. And for a very small amount of money, you can build your roofs slightly differently. You can build walls and windows slightly differently. They're different than your standard Home Depot windows, and so they are a little bit more expensive. But a hurricane came after most of these houses had been rebuilt. A hurricane came, and they looked at the map of the damage, and the only damage to the fortified homes were when a tree fell on the house. And so there's really no protection for that short of cutting down trees, and people are doing that too. But this was an amazing, I think, test of this standard, and it's probably not done yet being innovated. It's not a building code in the classic sense. It's a way of constructing, and you can get certified, and insurers will now in Florida and Alabama, insurers will give you a credit for that. So I don't think they have them for condominiums yet. But if they were built, they could probably build a new condominium to this standard or something that came to it. So that's why I say it's going to take, the average person lives in a home for 7 years. So a turnover is in 7 years. And when you do buy a new house, often you do stuff. So it will take a long time, 30 or 40 years, for the housing stock that's not historical or protected in some way to probably be renewed. And so, but it's never too late to start doing this. Now, that's the thing about resiliency.
Yeah, I also wanted to mention, Linda, I think you mentioned this in the beginning, the idea of people going without insurance. Obviously, that would create a much larger risk or much larger impact should an event occur. Are you seeing those types of conversations? I mean, that the impacts of this would be significant, both to the mortgage market, but also just personal finances. It seems like that would be difficult to recover from.
It's interesting, and I think you saw some of this in Fort Myers after the hurricane down there. You sadly had some insurance people talking to folks who are more my age, and so they paid off their mortgage and they have a home, and they had certain insurance agents who said, well, you don't need any insurance anymore because you own your home. Well, that is like wrong, just flat out wrong. And that was, it was always in the interest of saving people money. But you're trying to determine risk versus, how much money do you want to save? You're riding a thin line, especially in a place like Florida, but really just as much so in whether you live in California now or because of wildfires, or in a place like Iowa where we have like multiple wind and flooding events. But sometimes people make the decision to not get insurance just because they really and truly can't afford it. Because as Martin notes, the inflationary pressures have caused insurance to go up. And as that cost has gone up, people have to make some really hard decisions. And they're somehow in their own mind trying to figure out the risk challenge. Is it better to not pay this $2,500 to $3,000 a year and take that risk that I could literally lose it all? So in some disasters now, you're seeing people who are just walking away from their homes. They're just saying, I'm done.
I think a good rule of thumb is that, I'm sorry, I didn't mean to interrupt, but I think a good rule of thumb is if you're having this conversation about do you want to buy insurance, that's the sign you should probably sell your house. That sounds kind of cruel, but the cruelty is having the disaster and having nothing, nowhere to live and no money, to live. So, but I think so that means the risk of living there is too great for you. It's not just a weather risk; it's a financial risk too. So the combination of those two things changes the calculation, and if everybody was super rational and super smart, they would say, "Oh, I have to sell." But everybody says, "This is my home, dang it, I'm not leaving. You can't force me out." And they have an attachment to their property, which is totally understandable, given that I'm a human being too. I get it, but that's a major problem. And an insurance agent who would say something like that to somebody, unless that's like the conclusion rather than the advice,
Right.
That's just terrible. Because that's
sorry.
I'm going to say it's just terrible twice, it's twice as terrible.
Martin, you had made the point early on that, maybe insurance companies are overcorrecting at times when you see the data change or you see these events occur maybe at a different frequency than historically that they have when it comes to these severe weather events. How do you, change the modeling, or, what kind of innovation can there be so that gets more accurate?
Well, so there are people developing all sorts of models. We've had hurricane models for probably 35 years, and they're way better today than they were 30 years ago. We now have wildfire models, which are still in their infancy. We actually have terrorism models, which are terrible. So I don't know if, usually when software gets to a release, they call it version 1.0. I think terrorism is like 0.7 still. They're not really there, but they're still using it. That's the best they have. So what's making this difficult is that, 6 years ago, we really didn't have a wildfire risk. We had occasional ones all over the place. But now it seems whatever the weather patterns are, they're drying out the west part of the United States and Canada, that's having an effect. And so that happened in 7 years. And I think in California, they didn't recognize, the big insurers in California didn't recognize until three years ago that this was really a thing. And it started affecting insurers' willingness to insure in that area. California is also different because they never approve rate increases. I'm overstating it a little bit, but it takes years to get a rate increase, and they don't want to do it because they think they're helping the consumer. But the sad part of that is that companies are saying, well, we're going to stay with our customers. We're not going to sell anymore. And then they say, well, we're not even going to sell with our customers in this area. And then they say, we're out of here. So the state somehow are also, and you understand it because the voters just are tired of this and they don't want rate increases. But when you need one, the state is the first one to get in the way of that. And now sometimes companies do it, to see if they can get away with it. But California, there's no getting away with anything. And so the net result is leaving. So take California off the table. The next thing is, we need bigger insurance companies. And in Iowa, there's a lot of little dinky ones. They don't have the capital to sort of cover a large risk. And so instead of having risk pools across states, what you need to have is companies that operate across states and across markets. And the United States market is getting that way. Most of the even small insurance companies are owned by a large insurance group, and they may keep the local company name because it resonates in the area, but they're backed by like a large insurance company, and they supply the capital for that. But Iowa has a lot of small mutual companies that are locally run, and they're all their businesses in a couple of counties. They're just not big enough to do that. I don't know, Linda, if that was the kind of company that left you in the lurch, but they just can't bear this kind of risk anymore. They can bear very simple risks, not sophisticated or ever dynamic risks. So I think that it just takes time to learn, and we have learned it. Over the last couple of years, we've learned a lot about fire. We've learned a lot even more about hurricane and wind risk. The risk that we don't know much about, I think, is the derecho risk, because I actually never heard of these until Iowa was the first one I ever heard of. I don't know if they'd happened before and they just hit nobody. But
no, they've happened before. 2012, there was one in Washington, D.C.
And they're very rare, but significant and potentially lethal risks that, I don't know. We have a model for those yet. I don't know if the weather people can even predict them yet. So this is an evolving area, and as life goes on, we get better at it, but it doesn't happen overnight either. Even if you get the best minds, it takes a while to do this. And I think the insurance company and the reinsurers, they hire the best mathematicians, the best modelers, the best weather forecasters. They hire all those guys, and they have their own units that work on this. So they just have to get.
We're way better at risk modeling on floods and even hurricanes. But some of the other ones you mentioned, Martin, we're still, nobody's going to really be able to predict a wildfire. So there are some areas where we're doing way better just because the tools and technology are better. And as they improve, we'll continue to get better. And that allows us to be more prepared. But they by the same token, there are none of these that are going to get any better. And many of these extreme weather events are getting more extreme. And some of these aren't, it's more difficult to predict. There have been so many, but the one that went inland in North Carolina, that hurricane, Helene, that was, people tend to think of hurricanes and the damage they do on the coast. That one was different because it did move inland, and it sort of hung over parts of North Carolina and did just a massive amount of damage. So some of these are getting far more challenging to deal with and predict. Looks like we have a question.
We do. And the question is, state building code requirements for wind resistance would seem to have potential to persuade insurance companies for writing policies in Iowa. Could something like this help? And I think that goes back to the, what is local? Is it helpful when every town and county has its own building code? Or, is it something that maybe you get quicker change with a wider scale?
I think this the certification process for a fortified home by the IBHS, the Institute for Building and Housing Safety, I think it's called Home Safety. That I think is easier to sell than a building code, because a building code forces everybody to spend 30% more to build. And this may be cheaper, and you can choose. And if you choose, you get a discount. So this is the more libertarian approach versus the mandate. You have to all build to this fortified standard, and that has an impact on the cost of housing. But it gives you your choice. So I think this fortified program, if it needs to be adapted for Iowa, the insurers would like that. They would be able to provide a discount. I know I live in Florida in the summertime, which is I'm the opposite of a Floridian.
That's brave.
I have family reasons to do that. But I'm wearing my Iowa shirt, just so that you know. The discounts for having a wind remediation are significant. So my premium is 50% less because of these discounts. And Iowa, not regulated, but Iowa modified houses to withstand wind and hail probably would have an effect on your insurance premium. Now, you'd have to model that, and you have to convince the insurers, but Linda could convince an insurer. So all by herself, I don't know if it was you or the whole condominium association, but you convinced somebody, and that can be done. But, Linda's a very sophisticated person. She's been on both sides as a customer and kind of a policymaker. So she understands all this, but, average person who gets medium agent advice, not so much. So that's where the thing that FEMA does that's really nice is that they educate communities about their flood risk and the types of plans. I'm talking to community leaders, the managers. They educate them on what they can do to change the flood risk in their community. Well, that's the same kind of thing that could be done at a community level for non-flood risks too.
I am curious, there's been some discussion about, do you get rid of something like the flood insurance protection, the national flood insurance, because it's, stopping some of these changes from happening. And there's been quite a bit of conversation about, FEMA and, pushing responsibility back to the states. But it also, I'm curious your thoughts on that, because on one hand, how do you make these changes when there's no replacement infrastructure that's in place? You can't just make a shift because you don't like today's flood insurance program. How would you put this in place? And do you think some of that shifting is more political than it is practical?
I think that, there are a lot of things. The first is really addressing the fact that we have to make flood insurance actuarially sound, because in some respects, the federal government needs to be a little bit more like a business in this respect. Generally, I don't think it works, but they can't afford to keep losing the money they're losing in flood insurance because it's happening too much, and we know it is going to happen more. So there's going to have to be a change that addresses that actuarial problem. But whatever change you make, I was just at a conference and I was there with Brock Long, who's a former FEMA administrator under Trump's first term. And he has some fairly strong opinions on this that very clearly note whatever replacements we find, whether it's for flood insurance or for some of the big changes that might come at FEMA, you're going to have to run two systems in parallel, because you can't just pull FEMA out altogether and expect states to magically come up with the the resources. The federal government may, in fact, move to a flood or to a block grant program, but especially in states like, Iowa, South Dakota, Wyoming, Idaho, small states don't have big Homeland Security departments. They don't have a division of emergency management at the state level that is robust enough to do the administrative and interactive programs that now exist at FEMA. Sometimes when there's a lot of disasters going on, 2/3 of FEMA's internal staff are out in the field. And some states don't have that inherent ability to staff up and then go down and then staff back up and down. So, we're going to have to be really thoughtful. I know a couple of people that are on the President's Council, and I think there will be some challenge politically among senators, particularly in smaller states that don't have that robustness. And there is a bill that has passed the House and will go to markup in September that has at least some changes in it for FEMA. So I think we just have we have a lot to chew on right now about what will it look like. But I do think it is inspiring state and local governments to really recognize there are key things they need to do. And one of those things is not carrying uninsured property, whether it is from the locals themselves or from the government.
Yeah, I kind of thought that FEMA has two jobs. One is flood insurance, and that probably can't be handed off to the states in general, because I think the pool in this case is too small. It's just too small. But the other side is post-disaster relief, and I would think that given the small states, they don't have the staff, but they might be able to share staff. 3 or 4 states could enter into an interstate compact to do exactly that. But the federal government actually can do that better, except that's like one of the having it cross states, having it have this interstate notion. That's why we have a federal government. And some states like Florida and New York, they don't really need the federal government because they have good disaster staff. So Florida's had so many disasters they could take care of themselves. It's nice to have federal help, but they don't need it. Iowa probably needs it. So it's this there, and this is a but so we'll have to figure out how to do that.
All right. Well, I think we're right at 12:59, and so I want to be respectful of everybody's time. So thank you to both of you for the conversation that we had today. And for our audience, we will continue tomorrow. We are talking about ag impacts with severe weather, and then some public infrastructure on Friday. I again want to thank presenting sponsor ITC, as well as remind the audience that 2025 Iowa Ideas Conference is coming up October 2nd and 3rd. Our keynotes include Kirk and Mary Ferentz and Heather Gudenkoff. So I would encourage folks, you can register online. It's free to attend at iowaideas.com. Again, Martin, Linda, thank you very much for your time today. We are adjourned, and everybody have a great day. Thank you.
Thanks.